So thanks for having me here today. What I'm going to talk about is just this broader concept of analytics, and we call it this term Agile Analytics. I'll explain what that means. But just to give you some background, so I've been working in, professional services for about 16, 17 years. I started analytics using ACL and Access and Excel. Probably about, maybe about 12, 13 years ago when I started working on the Sydney Olympic Games. So some of you will probably guess my accent goes from somewhere, and now you will probably already know that I'm from Australia originally. So in Sydney Olympics, I actually managed the entire Olympic ticketing program from an analytics perspective. And when I walked in the door over there, I knew nothing about analytics. Right? I wasn't the analytics guy. My background is actually being a chartered accountant, the equivalent of a CPA. And my focus is on how do I continue to think about making the process more efficient. And so when I walked into the Sydney Olympics and I looked at ticketing, ticketing started with the basic building blocks of what Rutgers had done, which is we were looking at the IT general controls of the ticketing system. And we built it on from there. But in essence, what we eventually built was a program where, back then we didn't have some of the processing power we have today. So I had like 6 different very heavy-duty desktop computers all linked together that analyzed Olympic tickets. And did everything from when every single person completed the form for tickets, the program figured out who got the tickets based on mathematical algorithms. And so we did the analytics around that to make sure that every ticket issued followed those algorithms. We then went on to say, now you had a ticket, so how do we know where you sit in the stadium, whether it's track, whether it's the swimming pool stadium, whether it's the sumo wrestling? So then we had another program that ran which actually tried to figure out which seat you got in each of the venues. Thinking about if you had a family of, I don't know how many kids you've got, let's say you had a family of 2, so a family of 4, it was configured to figure out, well, there's only 3 left at the end of a row, so I have to automatically route Rod and his family to another seat in the stadium. And so we had to check all that as well. It did the refunds. It did the cultural programs. It did the Special Olympics. And that was all an analytical program. And it was very funny because we built these sort of 6 computers, and all we had back then was sort of Access and ACL. And as Chi mentioned, we went through a whole lot of script things. And we would come in and we'd load all these transactions being tickets, and it would just run through and either figure out whether things met the rules or whether it didn't. And then we analyzed the exceptions. Now, obviously, as we started putting the tickets in place, we started getting phone calls from, back then, obviously, the partners of the firm. I remember I was on the phone to the Office of Her Majesty in England, asking about their ticket status, and we had a general rule we couldn't even tell anybody about that, including Her Majesty. We had the Prime Minister of Australia, also had the US President call in as well. I don't know how they figured out these numbers, but I guess people find them out. So we had this hotline, and so suddenly we started getting all these phone calls. And the funny thing was, I didn't have the time to answer it. I got our intern to answer these phone calls, who were answering questions of presidents and prime ministers from all these countries, and they had no idea who she was, which was quite funny. So this concept of Agile Analytics, what you've heard so far is, most organizations, most companies always think about approaching analytics from a tool base. Okay? I'm not about the technology. As I said, my background is more around the business and finance. So my goal is not to talk about how you do it, right? What you do to do it, but why you do it. I'm trying to figure out what are companies struggling with today, and how can I leverage the data to answer that question. And when you think about that, here are a couple of imperatives to talk through. So first of all, every single company out there, in most cases, have very big, large systems. Whether they're database systems, whether they're enterprise resource systems like the SAP or Oracles of the world, whether they're in-house developed systems. When we think about how far we move today, a lot of organizations all capture their information electronically. I don't think I have any organization today that captures it manually. And used to have one up to about 3 years ago where they had the big ledger books, and that's how they record their financials. Very, very scary. Right, remember what I'm talking about. Enter an AP ledger in one journal entry. That AP ledger person walks over to the general ledger person in their book. They enter the same transaction, and they write a reference number. And at the end of the day, all these people, the AP, AR, general ledger, the big books, go and put it in the safe and lock the safe up. The next morning they come back and pull their own books out. Right? You're very surprised if anyone sees that now. 40% growth in data compounded year on year. Right? So all of you are in the right position in terms of where you are today in your career, then think about how you can leverage data to make a number of decisions going forward in your roles and whatever you choose after this program. And I'm going to talk about the elements of analytics and how you can use that in the business environment. Now, as Ron was mentioning before, there's a reason why none of the IT departments can work together. If they could work together, he wouldn't have a job. I wouldn't have a job, quite frankly. IT believe they are the folks that know the answers to leveraging data. They are not. Here's the simple equation. Everybody in business knows what the business issues are, know what they're trying to solve, know what it means to be successful. But they don't know what data is available to make those informed business decisions. So they make those decisions based on what they think they know is available in the organization. Right, top level. So in the IT level, they know exactly what's in every database, they know what they capture, they know what information is coming in from third parties, but they have no idea of how that is all structured to solve what the business is trying to achieve. So there's a disconnect between the fact that the businesses know what they're trying to achieve, but don't know what they have available, and the IT organization knows all of the data, but has no meaning in what it relates to the business. So when you have programs where IT are driving it purely, that's always a challenge. And you do get folks in IT that have a business savvy perspective, then you may have something that works. But if IT alone drive these value scorecards or analytics, you're not going to get them. Right? What you're going to get is a tool, or you're going to get a value scorecard or dashboard, which in their minds is brilliant. And I can show you many dashboards, but if it doesn't answer what the business is trying to solve, why do it? So you've got the businesses obviously trying to figure out what they can use. The other big thing is that we have so much data. How do I know what data I need? And so when you're trying to make business decisions, trying to get information out of IT is so slow. I can't tell you how many organizations I work with where IT are very protective of their data sets. If I can work in a world where the IT organization believes that they are enabling the business to achieve growth and performance, and therefore take down the barriers, I'd be a happy man. I may be a profit in that. Right? So that's the challenge. I'm trying to actually break down some traditional barriers that IT believe they own all of the information. It doesn't help any organization to grow. I want IT not to be viewed as a cost center. I want IT to be used as an enabler to achieve business performance. That is also the same for functions like internal audit. A lot of companies view their internal audits, their compliance function, as cost centers. I want them to be viewed as enablers of business performance or just protecting the business. Right? There's always two concepts I talk about, is these compliance functions either protecting the business, doing the standard blocking and tackling, versus actually helping to grow the business. Right? You've got to do this. You've got to make sure you meet all those compliance requirements. You don't do that, you won't even be in business. The goal is how do you do this and do it in an efficient way and then focus on growing the business. And that's where analytics comes. So here's the concept of Agile Analytics. And I'll walk through an example. I'm glad that Chisa talked about credit cards because I'll link onto that. My example was T&E, travel and employee expense, which some use credit cards. Probably not as advanced as the ACL Center. Let's see. So Agile, so think of the term Agile Analytics. So Agile is the component of instead of actually thinking about doing an analytic that may take 6 or 9 or 10 months to do, right? How many businesses today can wait that long? They want to know what value they can get straight away. So if my business issue is, how do I increase my working capital? I can do an analytic that's going to take 10 months to figure out what's causing issues to your working capital, where are the greatest opportunities to focus on improving your working capital. Here's how to quantify what I can do around the value. This is how to do it, and let's go do it. 10 months of actually now progressed. Right? The concept of Agile Analytics is take the broader working capital example. In the first 3 to 4 weeks, figure out what business specific issue is impacting your ability to generate working capital, and then only focus on that. So if the issue is around collections, right, your cash flow is not getting it, your working capital is affected by cash flow, due to collections, then just focus on that first. And the goal is, instead of doing, and I'll talk about this later, instead of doing 3 projects over 12 months, do 12 projects over 3 months. Generate value quickly, and for 2 reasons. One is so you can actually generate and show the business the value, and the second is you can build on that value. Yes?
Have you ever run into a situation where either the problem, there's like multiple huge problems that like you can't ignore like another, or a situation where maybe the big problem that like you're working on changes really quickly, so it's something else?
So it's a great question. I'll break it up too, because you're going to 2 scenarios. I have many organizations. In fact, every organization has big problems. Right? The question is whether they're willing to actually tell us about them. Right? So that's where the culture change has to happen, is that when organizations see you as cost centers, they don't share what's really happening. When organizations see you as an enabler to help them to achieve their business performance, then they start sharing what really happens. So many organizations definitely have issues and challenges, or what I call opportunities. Now, you can't do all of them. You can eventually do all of them, and as I keep talking to Rod about this, what I focus on is not doing one analytic and the next analytic and the next analytic. I focus on, when you start, that's what you do. So you build it as enterprise programs. So you actually build capacity where you can start managing multiple issues in the business. So instead of having 5 people, I now have teams of 100 that are working in one particular organization. So when you do go through those big organizations, multiple issues, what we try to do is we map it out and say, look, which issues are largest in opportunity but the low-hanging fruit? Where can we generate value quickly now? Because that small thing of value creates enough input to keep going forward, and it generates either revenue or it saves money. And then keep tackling the next one, right? And an organization may come to me and say, my business issue is I'm trying to figure out how to grow this particular product in this particular market, okay? Which is a definite business issue. But am I going to be able to solve that right now? Is that going to generate enough value to the organization? Versus, what if I have already a product out there that you're already launching and you're trying to figure out the right pricing strategies? Maybe I should do this one first, so you can actually generate more sales revenue in this product, and then I'll come back to this one. So there's always going to be a trade-off. The second one is when you talk about if the problems come back, the concept of the Agile Analytic is you take 3 months to build it, and then you think about what element of that problem you continue to solve, and it's a monitoring process. What the technology companies, this is around a commodity. I've got a product that tells you how your accounts payable is working. Here's the product running. What I focus on, what I'm going to talk to you about today, is a service. We're not trying to tell you what's wrong with accounts payable. We're trying to say, we're going to manage your accounts payable and take the risk out of it. Right, so you can focus on growing your business. That's a service. We are facility monitoring. I'll show you that. To answer your question. Yes?
I was curious about how you identify small from internal factors as to whether or not that is a priority over internal operations.
Right, so the question here is, how do you identify from the internal factors what's a priority or not? It's not necessarily easy. Some of it's what you just did before using voting software. So we go into an organization, especially organizations that are in turmoil or conflict, There's been many situations where one department doesn't like the other department, and there's different priorities. So we go in and say, let's first of all figure out what the potential opportunities are. And then we get together and essentially use, like you guys do, use a voting product, use this resolve the ballot product we've made in the market. And what we do is, there's different ways that you can get them to vote on this. And we tend to, what we do is, we take every opportunity, we use the 2-pen model, which is, which one is more important to you, A or B? And we keep doing multiple combinations of all the different opportunities in the same question, which one's more important? And then ultimately able to map what's more important to an organization when we get to the end of this. So we can see which ones they believe are high in terms of importance once we do multiple pairing questions. We also, and I don't know if Rod does it, he probably won't admit it either, that when I go in and set up these ballots sessions, I already know, I don't know on the software who has ballot pad 14, but I've written out where 14 is sitting in the room, so that I look up and say, Howard's sitting there, he's 14, Howard is procurement. I've written it down, so when I analyze the results, I can also go back and say, let me look at all my voting results and take out everybody except procurement. What's important to procurement? So I actually get a corporate view, and I can get a splice view of a function. Or even
not
geography.
that good.
That's why I have people there as well. Right? So that's how I sort of figure out what's going to take the company. And the great thing is that I don't tell them. They did the voting, their people figured it out, they all saw the results. So when we get to the end, we said, this is what you guys said was important to your business. You tell me what you think about it. The hardest thing you guys will find is that you're telling the organization what's important. You're going to, it's a fight. But if they did it themselves, and all you're doing is just reconfirming what they told you, it's a little bit easier to get to. Right? The other part that I love about data analytics is I let the data tell me what's going on. So they can tell me, this product, you say this product is doing poor, we're generating great sales. I can tell you what the data is telling me. The data is telling me that you may have great sales. But when I look at the gross to net calculation, you're losing all that money on the contribution margin line. When you get to the bottom level, your SG&A expenses are so far ahead of the other products that you're not getting any profit on it. And I'll tell you what countries are profitable and not profitable. Now, as long as you have, and especially as you said in the front part, one, you have the integrity of the data, so when you load it in the first place, check it, and you know you're comfortable with the analysis, all they're going to do is challenge what the data says. But if all I'm doing is just talking about objective facts, it's very hard for them to challenge that. Okay? So the Agile is thinking about how I create rapid value in a shorter period of time by focusing on small elements. So when I think about that, let's talk about what analytics is. Okay? Now, Ryan attended the risk summit that we run. They also do specific analytic innovation sessions with clients. And the first question I normally ask is, what is analytics? And you'll be amazed at some of the variations of what I get as analytics. Some of my financial institutions talk about analytics as being performance scorecards or value scorecards. They're KPIs, and that's all it means to them. Some of them talk about the financial close process. That's analytics. That's true. It's a concept of analytics. But it's definitely much more than that. So I break it down into these three categories. All of you are going to be comfortable enough, as you saw on the ACL demonstration, to look historically, to take some hindsight in terms of what are you learning from what happened in the past. Very much on the audit front, on the hindsight side. But this is also the challenge. If you're in an audit function, this is the challenge. I am an auditor coming in and telling you what happened. I'm telling you that you didn't approve all those journal entries. You didn't focus on making sure that all the expenses were approved. You spent on vendors with your corporate credit card that weren't approved business vendors. It happened in the past. And the struggle is that the business goes, well, how are you helping me? You're telling me what happened in the past. Okay, we did something wrong. We'll think about how we do it better in the future. But you're not going to change what happened in the history. So there's good insight from doing just in the hindsight, but it doesn't really give you some of the answers, right? So that's why we focus on insight. So insight is taking what you've learnt in the past and what's happening today, and analyze the data to think of what are the patterns in the organization. Now, I'll walk through an example in this deck of what that is, just to give you some ideas around it. But it seems like if I take the credit card data, what are our people spending on? Which vendors are they engaging with? Why are they doing that? So the difference is, on the hindsight, I'm going to ask the questions of what are people doing and how are they doing it, whether it's the credit card or not using the credit card. There's less of the why. When I talk about the insight, it is more the why. Why is it happening? Right? And then getting into, can I potentially predict what's going to happen in the future? Right? So why are only 86% of our people using the corporate credit card? Right? What are the other 14% doing? Why can't we use the corporate credit card? What transactions are they putting on the corporate credit card? In one particular example, I was doing an analysis for one of my pharmaceutical companies, and I still haven't figured out the answer to this. So there is around $200,000 every year being a business expense that's claimed on Victoria's Secret. Still don't know the answer there. What even is more interesting, again, do the analysis, it seems to peak on admin's day, or secretary's day. Now, last night I checked, if I go out and buy lingerie for my admin, I'm not sure what would happen, but I don't want to be in that position. But I still don't know what it is, right? And this is not, we've got enough data, so what we also do is we don't just take just what they submit, we go straight to the source. We go straight to American Express in this case. So we can break it down to, I can tell you they're not gift cards, so they're actually clothing. It's not perfume, it's clothing. $200,000 worth. So again, we raised that to the company. They're like, all right, give me the list of people. So I'm not giving you the list of anybody, especially for this stuff, right? So I'm getting insight into what's going on. So that's something we can take action on. I'm going to have to go, unfortunately, interview a group of these folks to understand what it's for, and then figure out whether they need to shut it down or whether they need to adjust for it. So that's learning is, as you go through things, you may find something that completely throws you out of the water. You figure out why they're doing it, and then if it's valid, you adjust for it. Right? I have another example, a different client that's actually down the road here. High volume expenses at Disney front desk. Right? And last time I checked, this client doesn't take people to Disneyland. You can organize it through the corporate office, but this is Disney front desk. They've already arrived at one of the parks, and they're putting huge amounts of money on the corporate credit card. Right? Now, I've already analyzed that, and this is just all personal. So using the corporate credit card to spend on personal. Right? Not acceptable, but at least it gives me some insight that this is happening. Foresight. Now, some of you may have heard this as predictive analytics. I get many organizations coming and saying, I'm really focused on the predictive analytics. I want to look forward. And when I figured out what they're talking about is more of your financial driver base. What drives my business, and how can I predict when my sales increases, when my employee numbers change? That's not what I'm talking about. Okay? That's my insight side. When I talk about predictive, and this is a very specialized area, what I'm really talking about is using statistical regression models, looking at specific standard deviation models to figure out where the company is going to go in the future. And I'll give you an example. So one of my life science companies is focused on diabetic research. Okay? So what we did is, from an insight perspective, we try to figure out, and this is getting into some of the advanced analytics, so don't go too extreme there. So what we said is, let's figure out where every single one of their locations are and their sales associates are. And then we actually worked and got IMS data, so the party that deals with all the drug distributions, and figured out where every single person that currently subscribes to a diabetic drug is in the United States. And we overlaid that on a map. So first we say to them, are they covering enough of the base on where they should be in terms of selling their product and the people that need their product? Okay? Response and demand. Then we said, from a predictability perspective, let's then analyze the people that are in those areas and determine how many of them are actually likely to be moving into a medical stage, unfortunately, where they're probably going to need this drug. Based on family history patterns, okay, based on also IMS data in terms of the drugs that lead ultimately to potentially moving to type 1 or type 2. And then we started predicting for the company where they should reorganize their sales associates and sales officers. That's a whole lot of mathematical model, and I'm definitely not the geek in the room. Okay, there are plenty of geeks to work on. Right? They're the ones doing these models, and they're trying to figure out where the company should go. Right? I can't show that to you today because it's very hard to sanitize that model. But that's the predictability side. So I would not try to go into that space yet because it's very, very specialized. I don't even play that space. I've got a team that does, another colleague of mine that purely plays in that space. But you're going to find so much value and you're going to have fun doing it in just the first two. Yes?
What's the difference between analytics and, let's say, operations?
Real loud, real loud.
What's the difference between analytics and operations analysis? Because it appears a lot of goals, methods, and methodologies.
Well, it's an element of analytics, so it's again how you interpret it. So for me, you call it operational analytics, was it? Or analysis? Okay. So there was a concept where I can take data from an operational perspective and perform an analysis to either figure out what's going on or what I can improve on. Right? That's, to me, analytics is the broad name, but that's a component of analytics. They're particular examples, and I'll show you on one of the pages. Operational type analytics is there as well. Analytics to me is the broader one. Everyone talks about it. Some people call it big data. Big data is actually something different. The other concepts of big data is, in most organizations, you have a data set, okay? Most of that data has structure, right? It belongs to a standard application. It has set tables. When you get into unstructured data, which is another name for it is big data, is there's no specific relationship between each of the various elements of data itself. You have to create it. So Rod mentioned before that in your ACL example, you have a multiple number of files that you brought in. Now, we would typically bring every single data point, if possible, into one source. Right? And that becomes almost our unstructured data set. Then we go ask the question, what can we solve from a business perspective, and then figure out what we pull from it. Right? Now, one thing that I noticed when she did this, just be careful when you put data sets together. Right? Again, lucky I still have an audit background. And when you start combining files, so when we have the transaction file, and you then map it to the codes, the vendor codes, did any of you notice that the records dropped? No? So the fact that when you join files together, you always need to remember that you've got completeness. And when the records change, it doesn't mean you've missed anything. But it could be in some of those cases, the vendors that won the transaction, we didn't have the codes for. I think in the codes you had about 400 codes. I've got about 18,000 that I've been sanctioned. Right? There's definitely a lot more vendor codes, and it grows and grows and grows. But that just means that you should always reconcile the fact that if you had 400 transactions and you dropped to just shy of 200, what happened to those other 200? I think the simple answer was we didn't have those vendor codes. Right? Doesn't mean it's going to limit your analysis, but just remember, every time you combine data sets, you've got to make sure you have integrity. If you do not have integrity in the data, none of this is going to have any value. Because it just one thing in analytics you'll learn very quickly is you can have such a big impact on an organization when you talk about, let me tell you about your organization because I've seen it in the data. But as soon as one person's asked a question around, well, what happened to that person because they're part of my sales organization and I don't see that on the list of sales associates, if you have one issue on integrity, the whole thing collapses. Your integrity is now in question. So you have to be very careful that when you work with data, you audit it all the way through and you check, double check, triple check to make sure that any questions around whether something looks off, you figure it out beforehand so you can answer it. Okay. A couple of data points, right? So we also analysed, we did this as part of our survey process. We looked at organisations that perform extremely well in the market. And we know that those organisations are performing 5 times more in use of analytics than those that are low performers. And I know you probably can't read in the back there, but just some of the, and these are the grey bars are the top performers here. There's some of the areas that they're performing in. So financial management and budgeting, obviously I think it makes sense. Operations and production, okay, I think that makes sense. Strategy and business development, so thinking about what emerging markets an organisation should work in. Should I open a sales office? Should I think about headcount reductions in certain locations? Again, all strategy and development. Sales and marketing is growing significantly, so areas around sales strategies, pricing strategies, gross to net calculations. We also have an example which our client is not happy right now, but not happy for us, but not happy for their distributor. They sell a product to a country in China. China. They sell a product into China, and they sell it through a distributor. And so they thought they sell it at a certain price, and the distributor sells it straight to market. What they couldn't figure out is why they were losing on the gross to net. And so we actually went and actually traced about 1,500 transactions, very hard to get data out of the distributor model in China. And we suddenly figured out the reason why they're losing margin is because that distributor sells it to another distributor, who then sells it to another distributor, who sells it to another distributor. So on average, they move between 4 to 7 distributors just in China alone, right? And you know why they're doing it? Because they're making money every time they sell it to another distributor. It's all internal generation.
Is there any way they can bypass that by going to?
Yes and no. So depending on what country you're selling at. So in China, for example, obviously to get the entry into their market is very challenging. So this is the way we would get in, or they could get in. So they can now go back and pressure the distributor, but there's no other way to go in unless we go to another distributor. In other markets like in India or Brazil, it's a little bit easier to get in there. But quite frankly, China has, in this particular case, they have a strong talent pool. So we want to actually, and they have a strong need for the product. So yeah, it works with it. But now what we do is, since we know they go between 4 to 7, we actually have put in a right to audit, and we actually track their data now. So we couldn't get their data because 1, they're in China, and 2, we didn't have a right to. Now, as part of the fact we figured this out, they could have said, let's go to a different distributor, which would have been the best, or you need to give us data so we can check on what's happening at prices. So now we're in the monitoring stage, we're in the assessment stage, we're figuring out what's going on. We may just negotiate with them and say, you know what, we're going to lock in our margin. So our transfer price between us and to you is this, and that's what you pay us. You can figure out what happens after that. And then if they want to on-sell it, they're losing the money. But we need the data, we need to be able to know what's going on. Some of the ones towards the bottom, I guess as you get down, like talent management. Right? This is one we're doing more recently. This is a little bit scary for employees. I'm sure I'd be worried about it if it happened in our organization, and maybe it is. So we now have an ability where we are capturing, for one organization right now as a pilot, we're capturing performance reviews, satisfaction surveys, we capture other pieces of information from how they operate in their job. We also pull external data from monster.com, a lot of recruiting websites, social media websites, and so we're able to assess what we call a talent management value score for each employee in an organization. All right, so we determine how much they are value to an organization as the first score, and secondly, how much they are at risk of leaving. And so we get to a stage now where we're having conversations with the CEO and the C-suite of the company around which people are valued to them. There are people that they don't want to keep, and quite frankly, they're encouraged that the risk score is high. There's others that they do want to keep, and so they know to go to those folks, and we talk about different strategies to make sure that we can change and increase the satisfaction score and reduce the risk score. Right? Now, some of this data is not publicly available. We actually purchase the data through structured agreements, so we can actually figure out and answer some of these questions. Right? This is where we get into some big areas where we're trying to figure out, areas where you don't actually have data available to you today. Brand or market management, this was a little bit more complicated because now you're trying to compare one brand to a competing brand. The best lot of data on that is obviously the competitors of our clients, so that's a little bit challenging. But we're working on that. Okay. So you can see that most companies, and you guys already know this, analytics is here to stay. And I'll show you an example that only a couple of weeks ago that came out on the New York Times. And it was a different way to present it. And media organizations now thinking about analytics as well. So the typical way that you see it in newspapers and on media outlets is very much data-driven tables and numbers. This one's very different. It's only 2 weeks old. I also looked at it from an internal audit perspective because this one had a conflicting argument. So we did this survey recently, and you can see on the far right-hand side, the gold bars represent where they're using analytics for the internal audit process. Risk assessment all the way down to monitoring. Right? Now, when I actually looked at the answers and went back and spoke to some of these chief audit executives, the VPs of internal audit, the chief finance officers, the controllers, it didn't tell the right story. What I found out subsequent to this fact is that they use analytics at the beginning. So at the start of the risk assessment process, they use it, and then they don't use it through the rest of the risk assessment process. But they tick the box. So this result is somewhat false in a sense. Right? So most companies are using analytics, but not comprehensively. And so that's why they're not realizing these tangible and intangible benefits. They're just using it to structure the risk assessment. They're using it in terms of flashy presentations in the reports, i.e. they're using graphics. They're not using the actual analytics to deliver it. So there's still a significant gap in the internal audit space. In the external audit space, still the same case. So I also still serve external audit clients. My external audit client actually uses analytics as part of the external audit delivery. They analyze sales orders, they calculate the earn-not-bill ratios, they look at payroll records, they look at all the purchase order records. We do inventory accounting across 900 plus branches, the branch distribution model. And so you can imagine the inventory they have across 900 branches across the United States. We can't go to every branch. So we use those records and do analytics on the inventory turnover. We look at the larger analytics to see when we last counted it. So we're looking at a rotational program of doing the inventory counts. That's in the external space. I mentioned this to Rod previously as well. I'm also working on them on right now is to figure out which branches does the company go to. So the company has as part of their program, across the 900, they have limited resources that they'll visit between 20 and 50 branches and do a review. Everything else is controlled self-assessment. Now, how they pick those branches? That one. You can go that much for a while. I haven't been in Hawaii for a while, so I'll pick Hawaii. Right? He doesn't do that, right? There was no real logic. So what we did is, and we're working through them right now, is that we're taking their business risk factors to thinking about staff turnover, non-approvals of rental contracts, inventory not turning over frequently enough, collections issues. Right? All of those elements feed into a risk-based analytical model where we actually risk rank. We take every one of those elements and we actually score them based on a risk criteria, and then we calculate a weighted average and say, of the ones that are on the weighted average, what are the top 10, top 20? And then we go to those branches. Right? And then you can pass that model again and again and again and just re-rank all the branches and figure out where we want to go. It also, we use answers to it. We also put in there that there's a risk scoring on when you last went and visited the branch. So they want to do it every 3 years. The analytic automatically increases the score on that particular metric based on how far away you are from when you last visited. So there's more likely to be picked up. Okay? And I'll show you an example of risk model. So the Agile component is always thinking about the business areas. Right? We're always focusing on what are the business things that matter most to the company, and target that first. Right? It looks at our ability to connect different parts of the organization together as well. So as I mentioned earlier, there was an example where I just picked up something actually on the printer of one of my clients, and it was about this conversation with FX exchange gain or loss. So as most of you probably know, that a company buys, enters into transactions or loans that are booked in foreign currency, and obviously as the currency moves, that value of that loan increases or decreases, and you need to record at least each quarter, if you're public, whether you have a gain or loss on it. So it's an unrealized gain or unrealized loss until you either sell that asset or resolve the loan. This organization had so much in foreign currency loans that every time they booked it at the end of the quarter, they were always booking a huge loss, especially because they were mainly in Europe, and the euro was fluctuating a lot. So we just said to them, well, what if, can we help figure this out with you? And we said, well, you already buy this much in forward contracts. So our business questions to you is how much do you want to actually protect your hedging exposure? So how much do you want to actually buy a forward contract that if the rate goes against you, your contract protects that, basically offsets it. So what's the gap between how much you're protected versus you're unprotected? And they told us that number. And then we said, okay, then how do you know, apart from every quarter, when you're in a huge loss that you didn't buy contracts, or you're in a huge gain that maybe your hedging position you can sell off contracts? And so we figured out a model where we said, okay, let's just take all their loans and we'll reprice every single one of them every day. It just downloads the rates, recalculates it, and does an assessment of their current forward contract hedging strategy. Okay. Then we go look at, so that looks great. Then the problem was people book the transactions at the end of the month and close. So how do you protect for that? Then we said, okay, we're going to stop that then. We're going to prevent people from actually processing transactions before the month end close, issued a policy recommendation that all of these transactions have to go through approval through the central treasury team. And that was the last part of it. So now they can actually predict whether they need to hedge more or less now. So there's fluctuations that used to be between 7 to 21% is now down to 3% on average. Right? It's lower than that. They were looking at about 5% as their margin. But they're lower than that. So again, it's thinking about what's going to do to focus on what's matter, increase business performance. The last part of it is how can you make better business decisions? Right? So a lot of the things we're doing around optimization is how are you using your headcounts better? How are you using your investment dollars? So on a project management perspective, are you getting better value from the fact that you're running large projects? Are you hitting your milestones? Are the resources you're using effective in delivering value? Most people put together a big project plan, but then when it comes to managing it and going back to what the original value was, they don't do that well. Okay. Any questions? Yes?
Yeah. In your introduction, you mentioned that compliance should not only be about rules and the rules of the firm, because without compliance, you don't be business anyway. But then you also mentioned that compliance should be about knowing how to grow the business. Could you explain how compliance could help grow the business? Because I'm thinking compliance is really about rules and regulations, so how does it create?
Sure. So if I take another, I work mainly in life sciences, I'm using life science example here. So we went through a process where when the company builds a drug, okay, now in initial compound stage, there are many FDA regulations and obviously many other regulations leveraged by multiple bodies. So that was the compliance area we focused on, which is what are all the things that we need to make sure are in place and to monitor that as that compound goes through the scientific stage, then ultimately into the clinical stage for trials, then obviously in the validation stage. How did we know that we were conforming with all the regulations under the CFR Part 2011, all the FDA regulations, et cetera, right? So that's the compliance side. Now what we use that for is that we help them figure out how they can grow their business because they've got all these scientists today that are working on all these experimental drugs. This industry has changed because most of these big pharmaceutical companies would buy a drug that was in clinical stage trials, so they had a good idea on whether it would be successful or not. Right? These days, everyone's trying to do that. So now most of these companies don't know what they're buying anymore. They're going to all these biotechnology companies that have something that's promising, but it hasn't even gotten to a stage yet where they know it's going to work or not. So what we use the compliance part is actually figure out how do we get that product as quickly as possible to market by the fact that we already put all these protocols in place, we're using them to grow their business. So as their pipeline program and the ability to go from basic compound to clinical trial is now much simplified because now they just pass it through a program where they don't have to worry about the paperwork, they don't worry about anything. Because the analytical program, red flags when something's coming up. So these scientists who used to like have they have a stack of papers and have to fill in every single time, we assume that they naturally do it now. If they don't, the analytical model tells us so and then we pick it up. Right? So now they're more focused on clinical development rather than to worry about the administrative side. So that's how we use it to grow their business. Okay. Any other questions? All right, so let's talk about sort of the components of the analytics, the Agile Analytics strategy. So as I said to you before, it's not about the technology. Okay? We lead with business-led questions. Tell me, so we were talking about before on, the health side of it. So if all of you want to, drop 20 pounds, right? So we all set the goal at the beginning of the year, we're going to set a weight loss program, right? Now, how many of those programs are successful? Not many, right? Now, but if I asked you, why are you trying to lose 20 pounds? Right? If you have a compelling reason why, you're more likely to going to stick to it. So I was talking to this my colleague yesterday. She's attending a wedding in 2 weeks' time, and she goes to me, I need to get to the gym and lose 5 pounds. I'm sure the girls probably relate to this. I assume it's the dress, whatever it is. So I said, well, why? And she told me that she's going to this wedding. So she's more compelled to go to the gym because she knows that she wants to fit in this dress and obviously be at this event. But if it was just I want you to lose 5 pounds and it wasn't a motivating factor, she's probably not going to go to it. Right? She's probably not going to achieve the 5 pounds. Right? 5 pounds is probably a little bit easier. It's probably your water weight. But if you make it 20, right, it's a bit of a challenge. Right? So when we think about everything to do with analytics, it's that same question. Find out the reason why it's important to the business. If all you're thinking about is what and how, what's the issue, how is it manifesting itself, and you don't know the reason why it's so important to the business, you're never going to get the buy-in. You're going to get IT there, but you're not going to be successful. It's a difference between doing one project, and that's the end of it, versus the sustainability of generating business value. You've got to understand what's important to the business. The first one, first two, first three projects are the hardest, because you have to prove that you're generating value. But once you get over that hurdle, it is so much easier. The thing on the right is the Agile component I mentioned before. Instead of doing those projects 3 over a 12-month period and waiting for that value to be realized, think about generating that value doing 12 smaller projects over 3 months. That's if you've got the resources. But still, if you don't, really isolate what the business issue is and focus on something that you can manage. If you can generate value on that piece, you will get to 12 months, but you would have done at least 4 projects that all generated value. We run a program that every quarter we figure out what the next projects are. Right? And it was a stage that we had to analyze all this data, and we would have to present to the business, business stakeholders. We've now flipped it. At 1 year we said, we're not going to invite anybody. We're going to do all this analysis, but we're not going to tell anybody anything. The only thing we're going to do is we're going to send out a message and say, we're having a data-driven quarterly event where if you would like something analyzed for us to help generate and resolve a business issue, then you can come talk to us. We had 150 people turn up. I was only expecting 50. All with business issues, very varied business issues. Right? People had and understood the value of the analytical program and the fact that we were focused on the business side. People want the help. They just don't believe it can be done yet. So once you create that belief, which is the top two, you're going to get there. And that's going to be done by this thing. So here's the other part of the secret sauce. Okay? So it's not about the technology tool. When we talk about analytics, there's really 4 key components. Okay? The top one is business domain experience. Now, I work for a professional services firm. So, I've got so many experts here and there, but they're not the people I'm talking about. I'm talking about all of you that work in your client organizations or your companies. You guys know your company better than I ever will. You know what you do better than what I ever will. That's the process domain experience. I'm leveraging that. Help me understand how we solve this issue. That's the top one. On the left, on the right-hand side, end-to-end solution delivery capability, fancy term for essentially the IT organization. I need someone to tell me what data we have available. How much is it? Where is it? Is it coming from external? How do we access it? Right? So now I'm doing together, what's the business issue and the people that know about the business issue in their business? What is the data that's available? Again, I don't know what I need right now, but I'm going to figure out, based on the business issue, and I know the knowledge of the data, what I can use. Okay. The analytical problem-solving mindset. Now, this is something that wasn't in organizations 5 years ago. Today it is, but it's still a challenge. So this is only spread across the organization. Sometimes it's internal audit, sometimes it's in the R&D section, sometimes it's in operational areas. There are people that are thinking about and leveraging data. Right? So we want to leverage them as well because they've analyzed the data in some capacity, so they have some insight. The real challenge is these, what we call analytics specialists or scientists. These are the folks that think about business and data and really think about, well, what really is the business challenge? So I know some of the business issues, I know what the data is telling me, but these are the specialized guys, which is what we do, is thinking about what specifically is the most important thing you can solve based on what I'm hearing the business telling me and what the data is telling me as well. Right? So a lot of cases, I can go in and say, I'm trying to solve accounts payable. I can go buy a tool, you plug it in and analyze the data, and that's the answer. That doesn't mean that's the right thing to look at. This is the resource I'm looking at. In our larger enterprise programs, we don't do any of these outside ones. That's all you. We're just there as a service advisor, which is tell us the issue, let's listen to it, let's look at some of the data, let's just make sure that we think you're focusing on the right thing that's going to generate the greatest value. And that's the best thing about this. It is the fact that there is a service where you can have a conversation to start with the process of where do I generate value, and then you have someone that can help you through the process, because every single organization is different. If you can get that skill set, that's great. Right? We have challenges getting that skill set. They're very limited. One of the reasons I'm here today, the place where this skill set is going to come from is going to come from colleges and universities. This skill set is not on the market. The skill set has been there before, and there's maybe about 2 to 3% that are out there, and these are the younger folks in our community that have just finished college. This is what colleges and universities focus on, is they understand that this is a big part of the new world, is that people that can translate business issues into how you leverage technology data and vice versa. It isn't the day of the accountants and the financial analysts and the IT folks. It's someone that can do both. Right? That's the skills, that's the opportunity all of you have. And then the collaborative model I just talked about before. This is all about integration of different parties. Business, IT, some sort of service provider, for us could be anybody. Right? But someone that actually is, the other thing to remember is that business and IT are ultimately going to work on the issues. What we try to do is, once it's set up, so we're going to the stage of, we had the question at the back on the compliance areas. We normally start with compliance first. You know why? Because you have to solve that issue. And once we solve it, that becomes a repeatable analytic. You don't go and spend time on it anymore. It just runs automatically in the background. And all we do is come back and think about how do we make that analytic smarter, focus on more specific issues, and what's the new thing to focus on. That's what we focus our time. What essentially companies work with us on is that we are thinking about it from a business-led perspective, and we bring innovation. As part of that service, if you go do something around working capital, we'll give it to you. And we'll come back in 3 months' time and say, guess what? Here's something else you can do in your working capital. Here's the innovation. Here's something, so you buy off the shelf product, we also give, it's the update on the upgrade product. These are the sort of portfolios of different issues that we've been trying to solve. We get the question on the operating side. So these cover finance, supply chain, customer, taxes, human resources, everything from invoice accruals, cost to serve, pricing analysis, research, transport sales, product returns, freight cost optimization, etc., etc., etc. These are just very quick summary, coupled in 2 or 3 words, for multiple business challenges that we've been solving. And if I was being honest, this is probably 1/4 of the full quilt, as we call it. Right? Every business has a challenge. Some of the business we deal with, we'll put this full quilt out there and say, if you don't know what issues you have, let's make it a little bit easier. I don't know it. But do you relate to any of these? And sometimes I walk out and they just keep circling all these things, like, okay, that becomes the facilitated session. We go, which one's more important? Okay. Again, you'll get this deck so you can speak to these. So let's talk about an example. I was talking about travel and employee expense, so I'll link to the credit card example as well. Again, different technology, okay? Again, not about the tool. Answer the question first on what we're trying to solve, then you can figure out the technology. So what I want you to understand is, you're going to go through all the ACL side. The ACL is the foundational tool that you can use to do this analysis. Right? It's not the only one. What I will show you is some of the tools that sit on top of it that visualize it. Right? You'll see what I mean with that. So I'm going to talk about this is just travel and employee expense. I have multiple ones, but the reason I picked this one is this is normally the one that most companies start the analytics program with. And the reason for it is very simple. It has multiple stakeholders. So when I go in and talk about travel and employee expense, I either go in and I'm talking to someone in the finance department about how I cut costs. That's one angle. I'm going into the fraud unit and they're looking for someone that's abusing the travel and employee expense. That's another angle. I've had very varied conversations with tax, and I'm not a tax guy, around IRS reimbursement, VAT, all the other various tax components. I've had conversations with our employees that are traveling overseas due to meeting VAT requirements, FCPA requirements, anti-bribery requirements. And then I've got people from an IT perspective thinking, how do I manage all of my employee expense? So it has multiple stakeholders that can actually pinch onto this. And this is how we do it. It's very simple, right? Again, business focus, right? There's no technology tool you go out and buy this, because this is not something that's canned. We always think about the different tests. So we think, we get data, but the analytics is focused on 30 plus, in fact, this is probably 50 now. Right? We are thinking about different things that we can do around what would be business issues or red flags in an organization. When I started doing one analytic around T&E with a client, and I was in a competitive bid. So they just gave us the employee expense statement, right? Straight out, all the expense reports. Right? So there's only so much you can learn from that, right? So I said to the client, you can give that to me. I don't know what I can tell you. I can tell you some basic stuff. But tell you what I do want. Give me all your corporate Amex data. Right? So what can I do with corporate Amex data? I can now look at who put it on their corporate card and who didn't put that expense in their corporate card. Okay? I asked for their airfare data, for their airfare booking data. I can now analyze who's actually generated the savings by booking 14 days in advance and not. I can actually compare pairings of cities. So if I was taking Siemens, I could actually go through with Siemens and look at where are the primary locations that Siemens have facilities at, and actually graph all the flights between all of those particular facilities and see what the average price is. That's how I started. Now I have actually airline data that I can look at. If Siemens is paying $500 on average for from going from, let's say New York to California, and the airfares, most of their flights are $300, why is that the case? Is it because all the employees are not booking far enough in advance? Or Siemens hasn't negotiated well with their travel agent? I asked them for their hotel data. So now I did this analysis and said, okay, of all of you who are staying in at the hotel, right? So let's just say that Rod has been very nice and takes you all out for a fancy trip somewhere, and you'll get a hotel. Right? Now, I would expect that you'll get booked together as a group, therefore you'll have the same rate. But I started doing this analysis where companies had conferences at hotels. Why did I get a huge differential in the rate? Especially when they were booked at the same time. So I've got people that are staying in suites, paying suite rates. I've got people that are at the corporate rate as well, that are charging the corporate rate through and breakfast. And when they don't realize the corporate rate includes breakfast. Right? It also gets me back to the optimization side. If your company spends most times in certain hotels and certain locations, and you don't have breakfast or internet or some of the basic functions like gym that people are already using and charging back, they tell you should negotiate that with the hotel. Right? So there's a way to optimize that. So I went more further than that. I went and got cell phone plan data, company car program data. So now I'm looking at their fleet. I'm looking at their cell phone programs. I'm currently now looking at their home shoring program. So this is all about trying to figure out the value. So what was 30 tests is now wrong. Right? But again, it's not a technology play. I'm trying to figure out what are the issues in the business. And all of those things are telling me something. Right? If you look at, we looked at all the different elements in the organization. So this is some of the prioritization we're talking about. We went and looked at the data and said, you know what? I will tell you that when we look at this, there were 5 areas that we think are high priority. And this is high priority based on the fact that we believe that there's potential non-compliance or saving opportunities, and these are big dollars. I'm not saying that none of the others were. Every single one of these circles. So when you look at vehicle mileage, communications, procurement, and other, they all had significant opportunity. But in my Agile component, over the next 3 months, where am I going to save money? Those top circles. Right? And that's 5% of their overall spend. And T&E is the second largest line of the SG&A. Obviously, payroll is the largest. That's big money. Right? And there's 2 components. There's a fraud component, which is a one-off saving. There's a savings and optimization. That's a recurring. Every year, by changing the cell phone expense policy, the mileage policy, you recognize that value every year. You save it. This is the employee risk ranking model. So I talked about the contract model, the branch model before. It's using the same business-related concept. We took every employee in the organization and we figured out a number of different tests from a T&E perspective. So amount of personal expenses, the percentage, use of corporate credit cards, potential duplicates, unusual transactions, which are using text word searches, and we build out a risk model. And we assign each of these a weight. What's more important versus the other? And then every employee is scored a risk score on this side based on that. And that tells us 2 things. So first of all, it tells us potentially which employees we should focus on. That's the easier part. But let's take it to the next level. So compliance, to your point, here's the compliance side. Now here's the business process side. When we said to the organization we did this for, we told them that the people the third party they employed that reviewed the expenses should be fired on the spot. Because the amount of things that were going through that were not compliant were significant. We said get rid of them, because I'll tell you what you could do is use your employees in those low-cost locations and use this model. And here's how you can do it. So right now, and some of you may relate to this, every organization analyzes all the employee expenses 100%. We said to them, forget that. Everything that's in policy has no red flags, you should just let them through. Everything that's in the top 10%, you should either send them to fraud or compliance, or definitely having someone review it. And the next 20-25% should always be subject to review. Right? This model is by employee, but it also goes by transaction. So every single line in the expense report, you can rate it to. We always start at this level first. If you go lower, it just gets to the roof. Right? And what do you think the executives said to us in this? What do you think the first question they said to us in this one was? What's my risk one? They want to know what they on the list. Right. Most executives are pretty high. Doesn't mean they're defrauding the company. They're flying around their private jets a little bit too more. Right? And this is the concept, the actual the sort of technology. So you can do all of this in ACL, so work out who's spending the personal mileage, who's using the corporate credit card for personal expenses, and then it sits on top of this, so it's all visualization. But the model is simple. Identify high-risk individuals, identify the transactions, continually update the model. So those executives that are high-risk score, we went back and said, you know what, we know why they are. They're an exception to the norm. Adjusted the risk model for them. And so the model updates, so they come down in the risk score. And then keep repeating it, and they're always down.
Do you ever worry about interdependent factors?
We do. So we actually, that's what we look for. We look for patterns, right? We look for, and that's part of more the predictability, is we link data points together if it makes sense. And then we measure the correlation between the data points. So then in the future, when we think about predictability, if this thing starts changing to a certain degree, we then say, well, the other factor is probably more likely to change. So let's make, if it's a good behavior, let's do it. If it's a bad behavior, we need to stop it. This is not about trying to find people. This is about encouraging the right behaviors. So we want everybody to come down off the risk model and risk scoring. So this also helps us to measure the training. You know, is policy working? Is awareness working? So hopefully everyone's coming down. Okay. Again, another way to look at it. So behind the dashboard, you can pick an employee, and then it shows you information about them. So it shows you on the top left side where they're spending their expenses, shows you monthly trends, it shows you the spend per employee, so we can figure out that someone was way out here, and they were doing fraud in the company, right? Way outside the norm. There are people who we actually figure out they should be fine. Right? And here's the benefit of it. So when you guys do pivot tables, again, if you do this in ACL, what's hard is that you can't necessarily see all the correlations, right? Some of the pivot table stuff, you can go do it and you put it all together and you can say, okay, here's all the people I want to focus on, but it doesn't tell you who did it, what were the transactions. This technology, there's many of it, as I click on each dot, so I click on the person in fraud, it always then tells me the individual records. So then I can always see what it was. Right? So it gives me the ability to actually analyze at the top level and then look at individual records that's causing it. I don't have to double click or go pull up another data set or open up a different table. I can do it all in one go, which is why we use it as a performance or value scorecard process. Any questions? I know it's not as advanced as ACL. Here's some of the other scary stuff. So, you know, if we're looking for potential fraud, right, no one's going to write the word fraud in their expense report, right? Maybe some will. They're the ones that everyone right? So this is free text searches. We're looking at just words. And we sort of look at words for the entire set, and then we rank them all, right? And you can use this in a different way, right? You can use it for someone that's buying inappropriate stuff, right? We have some people that are paying for landscaping on their corporate credit cards, right? The company doesn't do anything to do with landscaping, so what are they doing landscaping for? I had some people claiming flowers that were over $2,000 right, for a celebration and farewell lunch. So they're paying some of the people I work with $2,000 on flowers. I'm sure they'll be happy, but the company wasn't. So again, looking for unusuals, right? We can use it from, and this is from an FCPA perspective, a fraud perspective. Certain legislation, if you are obviously having mills with people that you can influence, like with governments or certain parties, that actually is against the law. And some countries you need to pre-register and to notify when you have these meals with government officials, department officials. So we can look at that as well. Right? We also look at an analytic, and I'm only showing you some of the visualization. We go as far as putting this on an iPhone or an iPad. So there is a rule for tax purposes that, say you fly to a country and you stay in the country for more than a certain number of days. If you do that, you actually cross over this threshold called permanent tax residence. Right? And as soon as you do that, it means you are now paying tax in that country for your visits. In some countries, you pay tax on your entire yearly income. Right? So that's a big cost to companies. So we want to make sure that when we look at all the travel data, we want to make sure that before you go to that trip, you're not crossing that threshold. And we make it simple because everybody said to us, how am I going to enter this stuff? It just takes so much time. We just basically put it in an iPhone. We said that when you do the booking gets dropped into the iPhone app and it quickly assesses whether you're going to cross over it. Or if you're traveling, what it does is every time you go to an airport and you get your boarding pass, you scan the code on the boarding pass and it enters it straight in. And then it can calculate. Right? So then it keeps a running total. So again, that's getting to the nth level. Right, and then real quick, these last two slides, I know we're running out of time, is focused more on how do you sustain it, right? So realization component. We've had many, many, many conversations with companies in this. I'm sure we've talked to Siemens about this too. Is that how do you do this? Because most companies sort of focus on, the financial elements, right? But we focus on a couple more. So it's easy to look at, hopefully it's easy to look at how much value capture you've got, how much financial gain or profit you're making. We look at how much innovation you're driving in your organization. How much is your talent learning? Our goal is to give the skills to you. Right? Our people are already developing this. How much are we doing from a strategic perspective? So every company has a strategic vision. They have their own fields of play. So if I'm playing around with working capital and it's doing nothing to advance where the company's going, it's probably not creating as much value as the company likes. And then talent creation. I know I'm biased, but this stuff is sexy. Come on. It's data. Can you imagine if you could analyze your partner's credit card summaries, how much you'd learn about them? Some of you probably don't want to learn about it. Right. Data tells you a lot. Right. Just like being a doctor, you can go look at blood reports. This is the blood in the organization. This is telling you what's going on. As long as you capture it, you can answer the question. And this one, innovation learning, here's a couple of ideas. Right? So everyone knows how I do that. So everything from training sessions, that's simple. Right? Solution catalogs. Every time we do an analytics, so we've created a portal where anyone in the organization that we work with can go to. What this has is when you go into the solutions catalog, it gives you examples of the reports, it gives you examples of what the business issue was, it gives you some working demos. We also do some other things. We create 5-minute videos. In those 5 minutes, we summarize the business issue, we actually show the simulation of the actual analytic, if we use one, and then we also have the person we delivered it to put the testimonial at the end. It sells itself. People love to hear from their peers and what value created. Education awareness. These are the simple things where we try to create demand at the C-suite all the way down to the new people that join your organization. People are very excited about this in terms of what it can do. And I talk about training. It's all about creating this culture. In most cases, there's already people that are excited about doing it. The people that are the most challenged by it is the folks that are senior in the organization. They get the fact that analytics can add some value, they just haven't seen it. Well, they've seen it and they believe it's sustainable. But most of you are probably too, sort of early in your careers, I know Rod knows what I mean when I say that. These are some quotes, right? So when we think about why analytics is of value, so 1 in every 3 make critical decisions without actually having that data in place, right? 1 in 2 don't even know what data they have access to. But we all know that if they had the data when they made those decisions, they would make better business decisions. Now here's the example I talked about a few weeks ago. Right? I've got this link and I'll send it to you. I think it's likely in the New York Times website. So who heard about the whole Apple story around this taxation, right? So most papers went out there and said, here's a list of all the companies and what their effective tax rate is. The New York Times in their Sunday review actually said, you know what? Let's just be different. Let's graph this visually, right? So they actually graph all the S&P 500 companies and all their effective tax rate, right? Now this is the summary slide. You can click on any one of these circles. I'm not on my machine, so I can't. And it will tell you what company it is. And this is based on public data. You can click on the show industries and it'll break it down by industry, give you another graph, and then you can still click on every single company. And there's also a search box, which is up there, where you can type in a company. As long as there's public available information, it will bring it up. And I was surprised at some of the companies on here. Very surprised. Especially when I went through some of the industry reviews. And this is great for me because now I know which clients to get talked to. Right? There are some companies like ConocoPhillips, who's way out here paying 60% effective tax rate. I don't know who's doing their tax over there, but someone's probably going to be fired soon. All right. Well, Apple obviously is way down this side. Whether they should be or not is another question. But again, isn't this more compelling when you look at it? Plus, you can put so much more on a visual, especially when you can move over the top. The only difference in our technology, again, I think it's on the same technology, is that you could click on a bubble and actually drill down. So we would do this to say which company you want to look at, and then drill down and look at the effective tax rate year on year. Right? There are factors, and we talk about linking factors. An effective tax rate could be high, especially because, say, for example, you're over here. I think it's an example here. AAG lost $83 billion by paying out $8 billion in taxes. So their effective tax rate is high because their base went down. So it's sort of artificially high. Right? So again, with data, you're trying to portray a message, but obviously I would like to see the build-up of the trend to truly understand. There may be higher in the recent reporting, and this is 2012. So what's the trend been?